A lot of people think dividend investing is slow, boring, or only for retirees. But the truth is, it can start with something as small as $20 a week and grow into serious life-changing income. Over the past couple of months, I've made a bunch of videos breaking it all down, from beginner strategies to deep dives into specific funds and real-world examples. So in this compilation, I've put together the most helpful videos, the ones that show exactly how to start building passive income step by step. You will learn why Warren Buffett loves dividend stocks, how much income you really get from $1 million portfolio, and whether DGRO or SCHD is the better ETF right now. You'll also see how to avoid common mistakes with Roth IRAs and 401ks, and how to build a simple setup that can change quarterly dividend payouts into a weekly $300 to $400 dividend income payout. Plus, the $20 a week plan that could turn into $7,000 a month. If you've ever wondered what actually works, not just what sounds good online, this compilation lays it all out. So grab a coffee, get comfortable, and let's get into it. Everyone knows Warren Buffett is rich, but most people have no idea how he actually gets paid. Spoiler, it's not stock trading. It's a slow, almost boring system built around dividend stocks that generates billions even when the market is crashing. In this video, I'm going to break down how he does it, the iconic dividend stocks that built his empire, and in the end, I'll show you Buffett's most recent buys, which might just become the next Coca-Cola, that currently pay him over $2 million in dividends every day. Now, before we break it all down into complex strategies or big financial words, let's ask the real questions. How does he do it? Why is he so obsessed with dividend stocks? And most importantly, what can you learn from it? Buffett, often called the Oracle of Omaha, doesn't chase flashy trends or the next big thing. He believes in owning solid, profitable companies that return cash to shareholders year after year. His secret technique? Buying businesses that generate reliable profits and then holding on to them forever. And these businesses send him a check in the form of dividends every few months just for owning the stock. Dividends are a company's way of saying, thanks for trusting us, here is your share of the success. For Buffett, those steady payouts are more than just a reward, they're a tool. While most investors focus on price charts and market timing, Buffett focuses on cash flow. And dividends are the most reliable cash flow you can get in the market. Take Coca-Cola, one of Buffett's legendary holdings. He started buying shares back in the late 1980s, and he's never sold. Why? Because every year, Coca-Cola pays Berkshire Hathaway hundreds of millions in dividends. In fact, he's set to receive approximately $816 million in dividends from Coca-Cola in 2025. This substantial income stems from Berkshire's ownership of 400 million Coca-Cola shares, each yielding an annual dividend of $2.04. This equates to around $204 million quarterly, or roughly $2.23 million daily. And those checks keep growing. That's income without lifting a finger. Multiply that by dozens of similar positions, and you start to understand the scale of his strategy. Even better, Buffett uses those dividend payments to buy even more dividend-paying companies. It's a self-feeding machine. Money comes in, and instead of just sitting on it, he reinvests it. This cycle repeats and compounds, and many of these companies are so strong they increase their dividend payouts over time. So Buffett isn't just earning passive income, he's earning growing passive income. So if you're wondering why the world's greatest investor prefers slow and steady over fast and flashy, the answer lies in the quiet, powerful world of dividend stocks. Let's take a look at the core strategy Buffett follows and how it turns steady income into legendary wealth. Warren Buffett once said, "Our favorite holding period is forever," and that's the backbone of his investing mindset. He's long warned against chasing quick wins or bailing out of good companies too early. In one of his iconic letters, he even said, "It's like cutting the flowers and watering the weeds." In other words, don't sell winners and keep losers, do the opposite. Buffett's strategy is almost shockingly simple. Find great businesses, buy them at reasonable prices, hold them for decades, and collect the cash they generate.
To buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price.
But he doesn't need to sell to make money. He lets dividends do the work. Over time, those dividend payments add up, and when they're reinvested wisely, the snowball just gets bigger. That's compounding in motion. All right, let's bring this all to life in the clearest, most relatable way. Let's say you invest $1,000 in a stock that pays a 4% annual dividend. That first year, you'll earn $40 in dividends. Now, instead of spending it, you reinvest it, buying more shares of the same stock. So now, you're not just earning dividends on your original $1,000, you're earning dividends on $1,040. Fast forward to year 2, your new dividend check is $41.60. You reinvest that too. And now your total investment grows to $1,081.60. By year 3, your investment is worth $1,124.86, and it's growing faster each time with more dividends. That's the power of compounding. Your money earns money, and then that money earns even more. It might seem small at first, but that snowball effect picks up speed. And when you stretch that out over a decade or 3, you start to see why Buffett doesn't need to sell to make money. He just lets the dividends do their thing, and the math takes care of the rest. So why does this pair so well with dividends? Dividends let you benefit from a company's success without selling your shares. Think of it like owning a rental property that pays you every month, but you never have to move out. You still own the property, it still grows in value, and you keep getting paid. Let's take See's Candies, for example. Buffett bought the company in 1972 for $25 million. It didn't become a tech giant or a global powerhouse, but it consistently made money. And because it had few opportunities to grow fast, Buffett took the cash it earned, millions in dividends, and poured that money into other high-return investments. It's a playbook he's followed again and again. To put that into perspective, if John had bought its shares in 1972 and held for the next 35 years while reinvesting the company's copious dividends back into the stock market, he would have turned a $10,000 initial investment into more than $387,000 after adjusting for the effect of inflation. That means $1.9 million in nominal terms. Buffett calls businesses like See's cash cows because they churn out money without needing a lot of maintenance. He loves companies that don't just grow, they generate. And that generation becomes fuel for more investments. It's an upstanding cycle. This method has helped Buffett ride out market crashes, bubbles, and booms with almost eerie calm. While others panic or sell, he collects checks and just waits. And while he rarely talks about excitement, his quiet confidence comes from knowing his investments are working for him even when he sleeps. But how did this play out in the real world? Which dividend stocks turned this strategy into real results? Stick around, because up until now, we saw Coca-Cola paying $2.3 million every day. Well, in the end, I'll show you Buffett's most recent buys, which might just become the next Coca-Cola. Okay, now let's get into the part where Buffett's strategy really shows results. Over the decades, Warren Buffett has turned those investments into dividend machines. Some of the most iconic businesses in his portfolio have paid Berkshire Hathaway billions over the years just for owning the stock, and that's no exaggeration. Let's start with Coca-Cola. Buffett began buying shares in 1988, and he didn't just nibble, he went big. Today, Berkshire owns over 400 million shares of Coke. That's a stake worth billions. Now, Coca-Cola pays Berkshire over $800 million every year in dividends. Back then, the dividend yield on his cost basis was decent, but now it's astronomical because he bought early during a dip in Coca-Cola share prices, and he held on. His yield on cost is now over 50%. This means Buffett is making half of his investment every single year without selling. Next up is American Express. Buffett began investing in Amex during a crisis in the 1960s when the stock was under pressure. Since then, it's grown into one of his largest holdings. Today, Berkshire pulls in hundreds of millions of dollars annually from American Express dividends. And just like with Coca-Cola, those checks keep getting bigger. That's the beauty of long-term investing. You don't just get paid, you get paid more over time. Then there's Procter & Gamble, another consumer giant Buffett invested in heavily through his Gillette acquisition. Though Berkshire eventually exited most of the P&G position, the years he held it provided plenty of steady, growing dividends. These companies all had one thing in common. They sold things people buy, no matter what, like toothpaste, soda, credit cards. Buffett doesn't invest in trends, he invests in habits. The real genius here is the discipline. Buffett didn't jump ship when things were slow. He didn't chase the next hot stock. He planted his capital in well-run companies, let them grow, and let them pay him back. That consistency turned into compound growth. And while it's easy to focus on the headline numbers, the hidden engine here is reinvestment. Every dividend that rolled into Berkshire became capital to buy more stock, and many of those purchases were just more of the same companies. Coca-Cola paying for more Coca-Cola, Amex dividends fueling more Amex shares. It's the investment version of recycling, and it made the snowball roll faster. What's even more impressive is the reliability of these companies. Through financial crises, recessions, and pandemics, Coca-Cola and Amex kept sending checks. That kind of dependability is rare in today's market, and it's a big reason why Buffett has stuck with these names for decades. When people talk about Buffett's investing genius, this is what they mean. It's not about picking winners. It's about building systems that generate cash like clockwork. These were the foundations, the plays that proved the system works. But Buffett isn't just living in the past. The next logical question is, what has he been buying in the last decade? And do those picks live up to the legacy of these dividend giants? So what has Warren Buffett been doing with dividend stocks in the past 8 years? Has he changed his approach? Not really. If anything, he's doubled down, but with a modern twist. The names might be different, but the strategy remains the same. Find companies that throw off reliable cash and hold on for the long ride. Let's start with the biggest and most obvious example, Apple. Buffett began buying Apple stock in 2016. At first, people were shocked. Why would the king of value investing go all in on a tech company? But Buffett didn't see Apple as a typical tech play. He saw it as a consumer brand with an ecosystem so sticky it resembled Coca-Cola, but in the digital age. And while Apple isn't known as a dividend monster, it does pay. And for Buffett, that steady income plus capital appreciation is the perfect combo. Apple's current dividend yield may be modest, around 0.5%, but the scale makes it powerful. Berkshire owns over 300 million shares, and that translates to around $300 million in dividends. Plus, Apple keeps raising its dividends slowly over time, and that's on top of the share buybacks, which increase Buffett's ownership percentage without him lifting a finger. Then there's Bank of America, another giant dividend play in Buffett's portfolio. Bank of America pays a dividend of roughly 2.44%, which translates to more than $797 million for Berkshire. But why does Buffett like it? Because it's a stable bank with consistent earnings and room to grow its payouts. Chevron and Occidental Petroleum are newer but increasingly important parts of the dividend picture for Berkshire. After Buffett shifted more attention to energy in recent years, these oil giants have delivered both capital gains and fat dividends. Chevron's dividend yield is around 4.77%, Meanwhile, Occidental has a dividend yield half of Chevron's, but it has strong growth potential. Berkshire has collected hundreds of millions in cash from these two alone, and with oil prices remaining high, that flow isn't slowing down anytime soon. Let's not forget Kraft Heinz, a stock that's had its share of ups and downs. Berkshire owns nearly 27% of the company. And while the share price has struggled, the dividends have not. The annual yield hovers around 5.7%, and Buffett continues to collect substantial income from it. So how do these modern picks stack up against the old classics like Coca-Cola and Amex? In many ways, they're doing the same job. They provide a reliable cash flow that Buffett can deploy elsewhere. Apple might not yield as much as Coca-Cola, but the dividend income is massive simply because of the size of the holding. Chevron pays more per share than most of Buffett's legacy stocks, and energy dividends tend to rise with inflation, which adds another layer of value. One underrated aspect of Buffett's recent buys is diversification across sectors that still deliver dividends. From tech to energy to banking, he's built a new layer of income streams. These companies can weather storms and still pay investors along the way. And remember, Buffett doesn't just want dividends for the cash. He wants the optionality. Having $1 billion a year coming in means Berkshire can jump on big opportunities fast. It's financial flexibility, and it's part of what's kept Buffett ahead of the game for so long. But what's even more fascinating is that some of these stocks, like Apple, don't even pay high dividends, and yet they're centerpieces of Buffett's empire. That's because to him, dividends are part of the picture, not the entire canvas. Apple might only yield around 0.5%, but its massive reinvestment into innovation and consistent buybacks make it a powerhouse of value creation. Still, when it comes to raw dividend power, it's hard to ignore the billions Berkshire now collects each year. Add it all up, Apple, Bank of America, Chevron, Occidental, Kraft Heinz, and others, and you're looking at over $4 billion annually in passive income. That's more than some Fortune 500 companies make in total revenue, and Buffett gets it all without selling a single share. And while these numbers are impressive, they're not just trophies on a shelf. Buffett uses this income to take action. He's not hoarding cash for the sake of it, he's using dividends as fuel. Every dollar that flows in from Apple or Bank of America could fund a new investment, a private company acquisition, or support buybacks for Berkshire's own stock. That's how the machine keeps moving. Buffett has always said he likes companies that reward shareholders, but the way he defines reward has matured. It's not just about dividend yield. It's about what a company does with its earnings. If a company like Apple reinvests 85% of its profits and turns that into new shares and products that make the company more valuable over time, Buffett is all in. If a company has nowhere to grow but keeps printing money like Coca-Cola or See's Candies, then a dividend makes sense. It's that clarity of thought that makes him different. Most investors chase either growth or income. Buffett chooses both, depending on the business. That flexibility has allowed Berkshire's dividend income to grow massively in recent years without sacrificing the long-term compounding machine he's always nurtured. And this brings us to the big question: which of these recent picks has the potential to be Buffett's next big dividend success story? Which of them might become the Coca-Cola of the next decade? Okay, so it's time to look forward. What stocks has Buffett added in the last 5 years that have the potential to become Berkshire's next dividend powerhouses or even the next Coca-Cola? One of the more intriguing additions has been Citigroup. It's been bought and sold. Berkshire's position in Citi raised a few eyebrows, but the rationale is rooted in classic Buffett thinking. The bank has a huge footprint. And while it's had its stumbles, it remains a core part of the financial system. Citi's dividend yield is 3.14%, offering Buffett another deep pocket of recurring income. While it's unlikely to become a top-tier performer like Bank of America, its current income potential is solid. If Citi stabilizes its operations, that yield could become even more valuable. There's also been a quiet but consistent accumulation in companies like T-Mobile. While not traditionally viewed as a dividend play, T-Mobile's recent moves suggest a pivot toward shareholder returns. It recently initiated a dividend and has room to grow both earnings and payouts. This could be one of Buffett's more forward-looking bets, a company that evolves into a dividend star over time, much like Apple did. Buffett's thinking around dividends isn't one size fits all. He has a rule of thumb, something he's mentioned for decades.
The first question is when you have capital, is it better to keep it or return it to shareholders? It's better to return it to shareholders when you cannot create more than $1 of value with that capital.
That line is simple but powerful. It means that dividends are great when a business has no better use for its cash. But if a company can reinvest its profits wisely and generate even more value, then skipping a dividend might be the smarter move. Take See's Candies. Buffett bought it back in 1972 for $25 million. It's not flashy, it doesn't innovate, but it makes steady money. Since it doesn't need much capital to grow, the cash gets funneled straight back to Berkshire in the form of dividends. It's like a vending machine that prints bills instead of snacks. Compare that to Apple. It does pay a dividend, but its real strength is reinvestment. Apple retains about 85% of its profits, pumping that cash into research, new products, and stock buybacks, and it's working. Buffett's stake in Apple keeps growing in value, not because of big dividend checks, but because Apple keeps making itself more valuable. This is why he hasn't blinked. Even after selling a small part of his stake, the remaining shares still represent one of his smartest plays. Another standout in Buffett's recent moves is Occidental Petroleum. Berkshire owns just over 25% of the company and continues to buy. The dividend yield is modest for now, but the long-term story is compelling. Occidental has been reducing debt, ramping up production, and showing signs of increasing shareholder returns. Buffett seems to believe the future dividend stream from this energy giant could rival his biggest past winners. And let's not forget about Chevron. Berkshire has invested tens of billions into the stock, and with a yield over 4.77%, Chevron stands as a rock-solid payer. It also increases its dividends regularly, giving Buffett that beautiful blend of steady cash and growing income over time. For a man who values predictability in an unpredictable world, Chevron is a textbook Buffett pick. No one actually knows which one will be the Coca-Cola of tomorrow. It's impossible to say for certain, but the candidates are clear. Warren Buffett bought Coca-Cola stock in 1988, investing around $1.3 billion. Today, that same investment pays him over $700 million every single year in dividends, meaning he's receiving over 50% of his initial investment back in dividends each year. Not from selling, not from timing the market, just from holding. You don't need billions to do this. You can get a comfortable retirement income if you have $200 a month to invest. In this video, I'll walk you and John through a simple 5-step roadmap to retire with dividend stocks. I'll show you how dividend reinvestment builds wealth and how to pick the right stocks to hold forever. In the end, I'll show you a 5-stock portfolio that with a $200 monthly investment, you can grow to a $2 million portfolio and pay over $10,000 in monthly dividend income by the time you retire. But first, let me explain why I chose passive income over capital gains. Most people think the only way to make money in the stock market is by buying low and selling high. That's the Hollywood version. Fast trades, wild swings, get rich quick. But in reality, it's exhausting. You have to constantly guess where the market's going, sell at the right moment, and hope you're not taxed into oblivion. It's like trying to win a game that you can't control. But what if instead of trying to time the market, you focused on getting paid consistently? That's the core of dividend investing. You buy shares in businesses that share their profits with you every quarter, every year, like clockwork. No guesswork, just income. Instead of stressing about when to sell, you're focused on which companies will keep paying and growing those dividends over time. That's what makes it so powerful. It flips the entire mindset from gambling on short-term gains to building reliable, long-term cash flow. The emotional payoff here is huge. With capital gains, your wealth is always on paper. Until you sell, it's not real. But with dividends, you get real money in your hands regularly. It's predictable, it's empowering, and it's incredibly motivating to watch those payments grow. And here's what's even better. That money doesn't stop just because the market dips. If companies are strong, they'll keep paying. That kind of resilience creates a sense of control most investors never get. It's the kind of strategy that lets you sleep at night and still build wealth while you're at it. So what makes this actually work? Let's be honest, most of us want financial freedom, but we're wired for quick wins. That's why so many investors chase fast gains and end up burnt out or disappointed. Dividend investing flips that script. It works not because it's flashy, but because it plays into two unstoppable forces: time and consistency. First, let's just talk about psychology. Humans are emotional about money. We panic when markets drop and get greedy when they rise. That leads to bad decisions, buying high, selling low, and jumping from one hot stock to the next. But dividends create a different mindset. When you know you're getting paid regularly, even during market downturns, you stop obsessing over price swings. Your focus shifts to income growth, not just portfolio value. In fact, this market fluctuation can work in your favor if you reinvest your dividends. This gives you two perks. One, you get the compounding effect going, which I'll explain in a bit. And two, you benefit from the dollar cost averaging strategy. Let's walk through a simple example over 3 years. You invest $1,000 into a stock priced at $20 that pays a 4% annual dividend. That gives you 50 shares and $40 in dividends after the first year. Now, instead of taking that cash, you reinvest it. The stock has dipped to $16, so your $40 now buys 2.5 more shares, more than you would have gotten at the original price. For reference, at the original price, you could have bought only 2 shares. That's dollar cost averaging in action. When prices are low, your dividends buy you more shares automatically. You're building your position at a discount without needing to time the market, and vice versa. In year 2, you now own 52.5 shares. At 4%, that earns you about $42 in dividends. The stock recovers slightly to $18 and you reinvest again, this time getting around 2.33 shares. Now you've got 54.83 shares of the stock. By year 3, those shares generate $43.86 in dividends. The stock is back at $20 and you reinvest to get 2.19 more shares, bringing your total to over 57 shares of the stock. You started with 50 and just by reinvesting the dividends, you've grown your holdings by more than 14% in 3 years without adding any extra money. That is how dollar cost averaging and compounding grow your wealth. Over time, this compounding becomes incredibly powerful. Even a small portfolio can balloon into something massive if you give it enough time and keep reinvesting every payout. Take UFP Industries, for example. Over the past 10 years, its average dividend growth has been over 20% annually. That means if they paid you $100 in dividends last year, this year it would be $120. Multiply that by dozens of companies and suddenly your cash flow starts snowballing. And unlike growth stocks, which you need to sell to make a profit, dividend stocks let you enjoy your gains without touching your principal. It's the difference between chopping down a tree for firewood and just picking up apples from it every season. Your investment stays intact, but it still provides regular value. Now, at the end of this video, I'm going to walk you through a real-life dividend portfolio, a combination of companies that, if built today, can turn a $200 monthly investment into a $2 million portfolio that pays over $10,000 in monthly dividend income. But first, how do we pick the right dividend stocks to hold forever? Well, it starts with knowing what kinds of companies deserve a permanent spot in your life. The goal isn't just to pick any stock that pays a dividend, it's to find businesses that can survive, grow, and keep sharing profits with you for decades. First, focus on dividend growth, not just yield. A high yield might look attractive up front, but it can be a trap. If a company is paying out too much of its profit, it might cut its dividend during tough times. Instead, look for companies that consistently increase their payouts every year. That's a sign they're healthy, profitable, and confident about the future. Let's take Visa, for example. The yield isn't huge, less than 1%, but over the years, it's raised its dividend more than 17% annually. Next, you want durability. Companies that have weathered multiple recessions, kept customers, and grown their business steadily. UFP Industries is a great example of this. It's been growing its dividend by over 20% per year, and its share price has climbed with it, thanks to smart management and solid fundamentals. So how do you balance growth and yield? Well, a good rule of thumb is to combine a few high-growth dividend stocks with some stable, moderate yield players. For example, Goldman Sachs doesn't have explosive growth, but it has a reliable yield of around 2% and a solid track record of performance. Blending that with a fast riser like UFP gives you both cash flow and future upside. Diversification matters too. You don't want to rely on just one industry. If you're dividend-focused, add a dividend-focused ETF like SCHD. It helps a ton. Based on these criteria, strong dividend growth, solid fundamentals, long-term appreciation, and diversification, I've selected these stocks for a retirement-focused portfolio. Each of these picks serves a specific role in the overall portfolio. SCHD, the Schwab U.S. Dividend Equity ETF, acts more or less as the foundation. It offers broad exposure to reliable dividend-paying companies and delivers a strong 3.93% yield, making it a steady, diversified core. Goldman Sachs brings consistency from the financial sector with a solid 2% yield and nearly 18% dividend growth, ideal for dependable income. Morgan Stanley plays the role of an aggressive dividend grower, offering a rare combination of a 2.8% yield and over 23% dividend growth, giving your income serious momentum. UFP Industries is the compounding engine, with a lower yield of 1.36% but over 20% in annual dividend growth. It's designed to snowball over time. And then there's Visa, a long-term appreciation play. Its yield may be small at 0.65%, but with consistent 17% plus dividend growth and strong fundamentals, it adds growth without sacrificing stability. Together, these picks balance yield, growth, and resilience, creating a portfolio built for long-term, retirement-focused passive income. Now the final piece, reinvestment. If your goal is long-term wealth, reinvesting dividends is non-negotiable. It turns income into more income. More shares, more payouts, and more compounding. You're not just investing, you're creating a system that feeds itself and gets stronger each year. So when people ask, how can I start dividend investing and never sell? This is how. Choose companies with growing dividends, strong fundamentals, industry diversity, and a history of resilience. Set it up once, keep reinvesting, and let time do the heavy lifting. But hold up, before showing you how this portfolio can turn a $200 monthly investment into a $2 million portfolio, there is a reason why not everyone does this. So let's talk about the trade-offs. Dividend investing sounds almost too good to be true. Steady income, no need to sell, and long-term growth. But like anything worth doing, it does come with some trade-offs. And if you're going to commit to the never sell strategy, you need to know what you're giving up and what it takes to stay the course. First up, growth envy is real. When everyone around you is bragging about 50% gains on a tech stock they flipped in 3 months, your 2% dividend yield might feel pretty boring. Your portfolio probably won't double overnight. That's because dividend-paying companies are often more mature, stable businesses. They're not focused on explosive growth. They're focused on returning cash to shareholders. And that's a feature, not a bug. You're trading hype for reliability and building a strategy around consistency. Another challenge? Patience. This strategy isn't Hollywood. It's slow and boring at times, to be honest, but it works for Warren Buffett. It made him billions, so it is more than good enough. At first, the dividends might feel small. You might earn just a few bucks a month. It's easy to question whether it's worth it, but remember, those early dividends are seeds. Reinvest them, and they start growing into more shares, which give you more dividends, and on and on. It's not about how it starts, it's about where it goes. This is a snowball you build piece by piece, and before you know it, it becomes unstoppable. You're also giving up the flexibility of quick cash outs. Look, if you're used to trading in and out of stocks, the never sell approach to retirement requires a mindset shift. You're committing to companies for the long haul, through the ups and downs. And yes, there will be downs. Even great dividend stocks can drop in value during a market crash. But if the business is strong, the dividends usually keep coming. And that's the income you care about. And let's be real, this strategy requires discipline. You'll be tempted to chase higher yields, panic sell during corrections, or pivot to the latest trend. The key is sticking with your system. That means reviewing your companies once or twice a year, making sure they're still performing, and resisting the urge to constantly tinker. Think of it like tending a garden, not ripping it up every season. Listen, the truth is every strategy has drawbacks. The question is, which trade-offs are you willing to live with? For dividend investors, the peace of mind, stability, and growing income are worth more than flashy short-term wins. And if that sounds like your style, then let's dive into the real numbers. Here's how this strategy actually plays out for your retirement. So, you know the stocks I selected, and you know each of their forward dividend yields, dividend growth rates, and their share price appreciation. But if you want to invest in a portfolio, you need to find these figures for your overall portfolio too. And that's actually fairly simple to calculate. To calculate the overall portfolio metrics, I keep it simple. Since each stock in the portfolio is treated equally, I just took the average of their individual numbers. For example, to find the average forward dividend yield, I took the dividend yield of each stock, 3.93% for SCHD, 1.94% for Goldman Sachs, 2.8% for Morgan Stanley, 1.36% for UFP Industries, and 0.65% for Visa. Then I added them up and divided by 5. That gives us a total of 10.68% divided by 5, resulting in an average forward yield for the whole portfolio of 2.14%. Why 5, you ask? Well, because that's the number of stocks I have in my portfolio. I use this same method to calculate the average dividend growth and average share appreciation. It's a straightforward approach anyone can follow, and it gives you a clear snapshot of what to expect from your portfolio overall. So, using the calculation, my portfolio has a dividend yield of 2.14%, an average dividend growth rate of 18.12%, and an average share price appreciation of 13.64%. Based on these metrics, let's see what the future projections look like if John invests, let's say, $200 a month into this portfolio. That's less than $7 a day, or for some, just the cost of a single cup of coffee. By the end of the first year, he would have invested around $2,400. This sets the stage for future growth. Fast forward 10 years and John's portfolio will be valued at $52,281. And if he keeps contributing and reinvesting dividends at the 20-year mark, things start to get exciting. His portfolio would be valued at $323,375, but the real magic happens over the long run. After 30 years, John's total investment of $72,000 from monthly contributions will have grown to a massive $2 million, $2,057,175 to be exact. His annual dividend income around that time would be approximately $129,240, or about $10,770 every month, enough to comfortably retire without ever needing to sell a single share. Out of the total gains, about $1.36 million came from capital appreciation and another $628,000 from reinvested dividends. Most investors don't realize they're leaving hundreds of thousands or even millions of dollars on the table, and it's not because they're reckless, it's because they picked the wrong dividend ETF. In this video, I'm going to break down the differences between DGRO and SCHD. Which one grows your portfolio faster? I'll break down their performance, compare their strategies, and help you and John decide which ETF might be the better choice for your $100,000 investment. In the end, I'll walk you through a side-by-side projection that shows which ETF could add an extra $2 million to your portfolio, pushing it past $5 million in value and generating more than $40,000 a month in dividends. But before we get into the numbers, let's clear up what these ETFs actually are. Because yeah, they're both dividend ETFs, but how they go about it couldn't be more different. Starting with DGRO, this is the iShares Core Dividend Growth ETF. It's been around since 2014 and comes from BlackRock, one of the biggest names in investing. It focuses on U.S. companies that not only pay dividends, but also have a consistent track record of increasing those dividends year after year. It tracks the Morningstar U.S. Dividend Growth Index, which applies specific filters to screen for financially stable businesses with sustainable payout ratios and solid earnings. DGRO holds over 400 stocks, giving you exposure to a wide swath of the U.S. economy across tech, finance, healthcare, energy, and more. It's designed to capture steady long-term growth from businesses that don't just return cash, they grow it. On to SCHD, or the Schwab U.S. Dividend Equity ETF. This ETF was introduced a few years earlier in 2011 and is managed by Charles Schwab Investment Management. Unlike DGRO, it targets companies offering higher dividend yields right now with good dividend growth, but it's very selective. SCHD tracks the Dow Jones U.S. Dividend 100 Index and screens for companies with strong financials using strict metrics like return on equity, dividend consistency, and cash flow. With just over 100 stocks, SCHD is more concentrated. But that also means it zeroes in on high-conviction, cash-rich companies that tend to be more mature and income-focused. So DGRO is broadly diversified and growth-oriented, while SCHD is more selective, yield-driven, and focused on financial quality. Both are strong, but they're built slightly differently. Now, let's see what those differences have meant when it comes to actual returns. Over the past 10 years, DGRO has returned 136.32%, showing steady and consistent price appreciation. In the last 5 years, it delivered 70.27%, and even over the past year, it was up 10.42%. That consistency makes it appealing for investors who value growth that doesn't come from wild swings. DGRO has handled both bull and bear markets with relative stability, offering a dependable track record for compounding returns. Now, it's not a monster dividend payer right out of the gate. Its current yield sits at around 2.2%. While not the highest, its advantage lies in the growth of those dividends. Over the last decade, its payouts have grown at a solid pace, giving long-term investors more income each year without needing to chase yield. It currently pays out about $1.39 per share annually, and that number tends to increase steadily. This makes DGRO a strong choice for those focused on building future income rather than collecting maximum dividends right now. Its expense ratio is a lean 0.08%, and the fund manages around $31.48 billion in assets. That combination of cost efficiency and scale adds to its reliability. The strategy behind DGRO, investing in companies that consistently raise their dividends, has clearly worked over time in terms of both price growth and dividend strength. Now shifting to SCHD, the numbers paint a different picture. Over the same 10-year period, SCHD delivered a total return of 103.64%. Over the last 5 years, it grew by 55.92%, and in the past year, it's up 3.97%. While these gains are still strong, they've trailed DGRO across each time frame. However, SCHD isn't trying to beat the market on growth alone. It's built for something else: income. Its dividend yield is 3.86%, a lot higher than DGRO's, and that makes a difference if you're someone who likes seeing real cash hit your account every quarter. It pays around $1.04 per share right now, and while its dividend growth is also very good, it lags slightly behind DGRO's. The fund is also extremely cost-effective, with a rock-bottom expense ratio of only 0.06%. It's large, too, managing over $69.93 billion in assets. That level of adoption points to strong investor confidence in SCHD's income strategy. And when you compare both to the S&P 500's 12.04% one-year return, you can clearly see the performance gap. DGRO came in at 10.42%, holding up fairly close and showing strong participation in the broader market rally. SCHD, on the other hand, delivered 3.97%, which is a much slower climb by comparison. That difference highlights how DGRO leans more into growth while SCHD is structured for income. While both are quality ETFs, they behave differently depending on what the market rewards in any given year. In the end, I'll walk you through a side-by-side projection that shows which of these ETFs could add an extra $2 million to your portfolio, pushing it past $5 million in value and generating more than $40,000 a month in dividends. All right, so we've seen how these two ETFs have performed over time, but to really understand why they've performed the way they have, we need to look into the holdings. Because what each one actually owns tells you a lot about how it works and what kind of ride you're signing up for. Starting with DGRO. This one spreads its money out across 415 different companies. That's a lot of ground covered, and it means you're not relying too heavily on any single business to carry the weight. In terms of sectors, DGRO leans pretty heavily into financials at around 22%, then tech takes up nearly 20%, and healthcare grabs about 15%. After that, you've got consumer staples, industrials, and utilities all showing up in decent amounts. There's also a sprinkle of exposure to energy, real estate, and a few other spots, but none of those smaller sectors make up more than 6% each. So there's nothing too lopsided here. And when you zoom in on the top holdings, the names all sound familiar. Microsoft leads the pack, followed by JP Morgan, Broadcom, Exxon, Johnson & Johnson, Apple, and a few others like Procter & Gamble and Home Depot. These are big, stable companies that don't just pay dividends, they've got a habit of raising them year after year. And even the top 10 stocks only make up about 26% of the whole fund, which keeps things well balanced. That's a big reason why DGRO tends to feel smooth and steady. Now, SCHD, it plays a tighter game. Instead of spreading its money across 400 companies like DGRO, SCHD sticks with just 103. That's a much more concentrated lineup, and it's very intentional. This fund doesn't try to own a little bit of everything. It's all about picking a smaller group of what it sees as the best, most reliable income machines out there. When you look at the sectors, SCHD leans heavily into consumer defensive stocks. That's stuff people keep buying no matter what, like food, drinks, or household goods. Right behind that is energy, and then healthcare. So already you're seeing a focus on essential industries with strong cash flows. It's also got decent slices of tech, industrials, and financials, and just a bit sprinkled across areas like communication and materials. But what stands out the most is how much weight it gives its top holdings. The biggest names? You've got Cisco, Coca-Cola, Verizon, Texas Instruments, Lockheed Martin, Altria, ConocoPhillips, Home Depot, Chevron, and Amgen. And here's the thing, those 10 companies make up over 41% of the whole fund. So when any one of them makes a big move up or down, SCHD feels it more. That can be a good thing when these stocks are doing well, but it also means SCHD is a bit more sensitive to individual company performance. In simple terms, DGRO spreads its bets widely with a growth-oriented tilt, while SCHD builds a high-conviction portfolio focused on quality dividend payers with strong fundamentals. And speaking of how much these ETFs pay you, let's talk about what really matters to a lot of investors: dividends, taxes, and that steady cash flow. For many investors, especially those looking at ETFs like DGRO and SCHD, the question isn't just how much will it grow, but how much will it pay me and what will I owe on that? Both DGRO and SCHD pay dividends quarterly, so you're receiving income 4 times a year. That's a big plus for people looking to build passive cash flow or reinvest their dividends over time. The big difference comes down to the size of those payouts. SCHD's current yield is 3.86%, while DGRO's sits at 2.19%. That means for every $10,000 invested, SCHD would pay out roughly $386 per year in dividends, while DGRO would generate closer to $219. If you're counting on those dividends as income either now or down the line, that gap matters. But dividends also come with taxes. For most U.S. investors, both DGRO and SCHD primarily pay out qualified dividends, which are taxed at the long-term capital gains rate, not ordinary income tax rates. That's good news. Still, if you're holding these in a taxable account, you'll need to report those dividends every year, even if you reinvest them. That's why many people choose to hold dividend ETFs inside tax-advantaged accounts like a Roth IRA or traditional IRA. In a Roth, your dividends grow tax-free. In a traditional IRA, you defer taxes until withdrawal. Both options help you get the most out of your reinvested dividends without losing a chunk to the IRS each year. In a couple of minutes, I'll walk you through a side-by-side projection that shows which of these ETFs could add an extra $2 million to your portfolio, pushing it past $5 million in value and generating more than $40,000 a month in dividends. But first, a piece of the puzzle that a lot of people skip over. How does it feel to own these things? Because numbers are great, but if your portfolio is making you lose sleep at night, that's a problem. Let's talk risk, volatility, and peace of mind. Now, both DGRO and SCHD are designed to be more stable than the overall market. That's part of the appeal. But they each go about it in slightly different ways, and the result? A different kind of ride for the investor. Starting with DGRO. It's kind of like that friend who never panics. Its standard deviation, which is just a fancy way of measuring how much the price moves around, is about 11.7. That's on the low side, meaning it tends to glide instead of jump. Its annual volatility? Around 15.1%. Again, that's pretty chill compared to the average ETF. So if you're someone who likes consistency, this is a fund that doesn't get too rattled when things get noisy in the market. DGRO also has a low turnover rate, only 25%. That means it's not constantly switching out stocks, which helps keep things more predictable, especially if you're holding it in a taxable account. Fewer trades mean fewer unexpected tax bills, and that's a win in anyone's book. And then there's tracking error, which tells you how closely the fund sticks to its intended index. Over 1 year, DGRO's tracking error is about 7.7%, and over 5 years, it drops to around 6.2%. Not perfect, but pretty solid. That consistency helps explain why DGRO feels like a smoother, more stable ride, not flashy, but dependable. SCHD, on the other hand, comes with a little more personality. It's not a roller coaster, but it definitely has more ups and downs compared to DGRO. SCHD's standard deviation, remember that's how much it tends to bounce around, is about 14.6, which is noticeably higher than DGRO's. Same goes for annual volatility, which clocks in at 16.3%. Still not extreme by market standards, but it does mean you'll probably notice the bumps a bit more, especially when the market gets shaky or interest rates start doing their thing. Its turnover rate is a bit higher too, sitting at 29%. Still relatively low, but it suggests SCHD does a bit more shuffling in the holdings. And more movement can sometimes mean more surprises when it comes to taxes or performance. Now, here's where things really stand out: SCHD's tracking error. Over the past year, it's been about 13.2%, and over 5 years, just under 10%. That tells us SCHD doesn't always stick super closely to its benchmark. It's not necessarily a bad thing, especially if the fund manager's strategy is working, but it does mean the result can sometimes drift a bit from what the index is doing. And remember how SCHD puts a big chunk of its money, over 40%, into just 10 companies? That kind of concentration can be powerful when those top names are doing great, but if one or two of them stumble, it can weigh down the entire fund. It's a double-edged sword: more focused potential, but also more exposure to single stock swings. From a technical standpoint, both funds score well. DGRO currently carries a strong buy rating, while SCHD is rated buy, showing strong momentum in both, but with more enthusiasm leaning toward DGRO. But of course, performance, cash flows, tax-smart strategies, and technical analysis are only part of the puzzle. If you're thinking long-term, like really long-term, the next question becomes, what happens to that $100,000 investment over 30 years? Let's run the numbers. Starting with DGRO, I'm working off some reasonable numbers collected based on the past 10 years' data, that your investment grows at about 9.08% a year in share price, with a 2.2% dividend yield, and that those dividends keep growing at roughly 12.5% per year. Based on these metrics, after 1 year, your $100,000 investment will be valued at $111,280. After 10 years, you'd be looking at $301,140. That alone would be impressive, tripling your money in a decade with no added contributions. But things really take off after that. By year 20, your portfolio would hit just under $1 million, $994,909. And by year 30, it explodes to $3.74 million, paying you nearly $16,000 per month in dividends. That's $191,300 a year just in income. A big chunk of that comes from those dividends being reinvested and compounding along the way. When you break it down, about $2.38 million of your total comes from capital appreciation, and another $1.25 million comes from reinvested dividends. So here's the big question: can SCHD beat that? Well, let's run the numbers. Same starting line, $100,000, but the numbers are just a little different. SCHD grows a bit slower on the price side, about 7.45% annually, but its dividend yield is higher at 3.87%, which grows at about 11.3% a year. No extra contributions, just time doing its thing. After the first year, your SCHD portfolio will grow to $111,320. Fast forward 10 years and you'll be at $312,338. 20 years in, your portfolio would climb to $1.17 million. And by year 30, you'd be looking at $5.78 million. That's nearly $2 million more than what DGRO delivered under the same time horizon. But it's not just the total value that grabs your attention, it's the income. By year 30, SCHD is projected to pay over $46,000 per month in dividends. That's $562,560 every year. So where's all that value coming from? About $2.5 million is capital growth, the rising share price over time. But a massive $3.17 million comes from reinvested dividends. That high yield, when paired with time and compounding, turns into an absolute powerhouse of income. So, which one is better, DGRO or SCHD? Between DGRO and SCHD, both are solid ETFs, but if we're calling a winner, especially from a long-term investor's point of view, SCHD takes the crown. Here's why. Over 30 years, SCHD turns $100,000 into roughly $5.78 million. DGRO, around $3.74 million. That's a $2 million difference. Even more important, SCHD's projected annual dividend income hits $562,000, or about $46,800 a month. DGRO, around $191,000 annually, or $15,900 a month. That's more than double the cash flow. Now sure, DGRO has smoother price swings and a slightly more diversified approach, but when you zoom out, when you really look at long-term value creation, SCHD's higher yield and compounding power just hit harder. So you're getting more income, more reinvestment, and more total return. So unless your number one goal is avoiding a few percentage points of volatility, SCHD is the ETF that builds wealth faster and pays you bigger over time. It's simple. More income, more total growth, more financial freedom. That's why SCHD wins. Retirement feels far away until one account choice shaves a full decade off the journey. And most people don't even know there's a difference. Today, I'm putting the Roth IRA and 401k head-to-head. I'll show you and John which one gets you close to a retirement fund of $1 million. I'm going to run real numbers, break down everything you need to know, and simplify it all in a way that actually makes sense. And in the end, I'll show you which of these two accounts will add an extra $90,000 to $100,000 to your retirement fund. All right, first, let's break down a Roth IRA in plain English. Think of it like this. You've got a jar. You fill that jar with money you've already paid taxes on, like money from your paycheck after taxes have been taken out. You'll never owe taxes on the profits when you pull it out in retirement. You put that money into your Roth IRA jar, then you let it sit. And while it's sitting there, it's not just hanging out, it's growing. Because inside that jar, you can invest in things like stocks, index funds, or ETFs. So the money has a chance to grow a lot over time. Now here's the special part. When you retire and take that money out, you don't have to pay any taxes on it. Not on your original money, not on the profits made. Nothing. Uncle Sam doesn't touch a dime of it. There are some rules, though. You can only put in up to $7,000 a year if you're under 50 in 2025, and there's a limit on how much income you can make to be eligible, $161,000 a year if you're single. If you earn more than that, there are still some ways to get money into a Roth, but that's another conversation. Also, you can't touch the earnings, the profit your money makes, without penalties until you're 59 and a half, unless it's for certain exceptions like a first-time home purchase. But, and this is big, you can take out the money you originally contributed anytime, tax and penalty-free. So if you put in $6,000 and need it 5 years from now, you can pull out that $6,000. You just can't touch the extra growth until retirement. One more thing people love about Roth IRAs, there's no rule forcing you to take the money out at a certain age. Most other retirement accounts require you to start withdrawing money by age 73, whether you need it or not. But with a Roth, you can leave it growing for as long as you want. So in short, you pay taxes now, let your money grow, and take it out later totally tax-free. It's simple, powerful, and gives you a lot of flexibility along the way. And that's what makes the Roth IRA such a fan favorite. But before we crown it the champion, let's see what the 401k brings to the table, because it comes with its own set of perks and surprises. Now the 401k. It's like having a retirement account with a built-in booster pack thanks to your employer's matching contributions. Here's how it works. You contribute a portion of your pre-tax income, and in many cases, your employer will match part of it. That's free money going directly into your retirement. Now, the big difference between a 401k and a Roth IRA is when you pay taxes. With a 401k, You're putting in money before it gets taxed, so it actually lowers your taxable income for the year. That might mean a smaller tax bill today, which is great if you want to keep more cash in your pocket right now. But here's the catch. When you retire and start taking that money out, Uncle Sam wants his share. Every dollar you withdraw gets taxed like regular income, so it's sort of a pay-later system compared to Roth's pay-now approach. As of 2025, you can contribute up to $23,000 a year if you're under 50. That's a lot more than a Roth IRA allows, which is one reason people really like 401ks. You can save a bigger chunk of your income, and with that employer match, the total can grow really fast. 401ks are great if you expect to be in a lower tax bracket later or if you want to get the biggest possible employer match. That said, there are a few trade-offs. Your investment options are usually limited to what your employer's plan offers. You don't get to pick just anything, like you can with a Roth IRA. And once you turn 73, the government says you have to start taking out a certain amount of money each year, whether you need it or not. These are called required minimum distributions, or RMDs. Still, if you're someone who thinks you'll be in a lower tax bracket when you retire, or if your company offers a solid match, a 401k can be a powerful tool to build wealth. It's like having a financial boost built right into your paycheck. So now that we've covered both options, the Roth IRA and the 401k, the big question is, which one actually gets you to retirement faster? Let's find out by putting them head-to-head with a real example using John. Let's say John works on Wall Street and makes $60,000 a year. He's 30 years old and has decided to put away 10% of his income, that's $6,000 a year, into a retirement account. His goal is to retire comfortably and spend his golden years sipping margaritas on a sunny beach. He's got two choices on the table, a Roth IRA or a 401k, but which one actually works better for him and leaves him more of the retirement balance? Now, John doesn't want to overthink it. He just wants to invest smart. If he chooses the Roth IRA, he'll pay taxes on that $6,000 now. But the money grows tax-free and he won't owe anything when he takes it out later in retirement. With the 401k, he gets a tax break now, meaning he'll pay tax on a $54,000 income instead of the full $60,000, resulting in less tax this year. But everything he takes out later will be taxed as regular income. There's also this little bonus with the 401k. His employer offers a 20% match. Now, to be super clear, most companies don't match 20% of your total salary. What we mean here is 20% of what the employee contributes to the 401k, so not 20% of John's total income. If John contributes $6,000 of his own money, a 20% match would mean the company adds 20% of that amount, $6,000, to his contribution, which comes out to $1,200. In real life, employer matches typically look something like this. We will match 100% of your contributions up to 3% of your salary, or we'll match 50% of your contributions up to 6% of your salary. So if you earn $60,000 and contribute $6,000 to your 401k, depending on the company's policy, you might get a match anywhere from $1,800 to $3,000 or more. But $1,200 is a fair, modest estimate for our comparison today. It's not meant to be a universal rule, just a simple number that helps us compare Roth IRA and 401k side by side in a way that's easy to follow. Now, Roth has a different kind of edge, flexibility. If something unexpected happens, John can pull out the money he originally contributed anytime, no penalty. With a 401k, that's trickier. If John